Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Just to remind all of our listeners, we're giving away a free silver ounce round, American Eagle silver ounce round, each and every week, Palisade Radio. Just go to palisaderadio.com and input your email for a chance to win. All of our listeners get a silver report on how to invest in silver by signing up there. Returning on the show with us today is Matt Geiger. We've had Matt on the show before. He's a very good friend of mine. Matt runs a fund, a resource-focused fund, and he also is based out of Silicon Valley and runs I guess, tech company with an app that they have and that's growing. Matt, welcome back to the program.
Thanks for having me, Colin, and much different conditions than when we touched base in late 2015. It's an entirely different market dynamic right now.
Oh, yeah, of course it is, and I've noticed that a lot of the interviews 6 months ago were focused around figuring out when a bottom was in and protecting capital, whereas now everybody's kind of, 80 to 100%, maybe even over 100% invested in the sector and just trying to figure out the best strategy to make money. Even a lot of questions starting to pop up about cycle timing and, is it too late to get in the bull market cycle? I've had a lot of listeners reach out to me saying, listen, some of these majors are up 300%. I feel like I've missed the boat. And that's sensical thinking, but at the same time, we have to realize just how bad things got, how cheap things got, and how much upside still exists. So, Matt, let me just start with the question, broad stroke on cycle timing. Where do you think we're at right now?
Sure, Colin. Well, the first good piece I would recommend investors going to your website and checking out the cycle timing chart from Palisade Research. I found that particularly informative. It's right there for you to observe, and it basically shows two obvious things. The first is that we're an extremely cyclical business, and that can't be taken for granted. So when things are going straight up, when things are going up, it feels like they're going straight up. And when things are going down, they're going straight down. And we've witnessed this over the past 4 years on the downside. And now we're just beginning to see the reversal and a bit of a bull cycle. The other thing the chart demonstrates is that in general, bear markets are the authors of bull markets, and bull markets are the authors of bear markets. And what that means is, it's glib to say, but the timing as well. So the severity of the bear market will often indicate how lucrative the preceding bull market will be. And in this case, we went through such unabated misery in 2011, 2012, 2013, all the way through the end of 2015, that even though the gains at the beginning of the cycle have been extreme, particularly in the precious metals and some other opportunistic names, I think we do have a long way to go. There are a bunch of opinions about how this cycle will play out. There are a couple people I'd like to point out. Frank Holmes, interestingly, had an interview recently, and he's discussing how generally cycles will last between 4 to 5 years. I'm on board with that. I agree with that perspective, particularly when looking at this most recent bear market. So it's very hard to predict exact timing. Anybody telling you the exact day, the exact month, the exact quarter when any cycle is going to end and turn over is fooling themselves, fooling you or both. But at the same time, you can have a rough idea about what's going to happen. My opinion is that after the severity of what we saw in this past bear cycle, we're going to see this current cycle last between 4 to 5 years. It may be a little bit sooner, it may be a little bit longer, but I think that's a reasonable assumption at this point, barring some cataclysmic macro-related event that you really can't plan for as an investor. And I think it's reasonable to assume that we're going to see gains through the middle of 2020. That said, it's not an exact science. And another great quote I'd like to point out is Frank Justra and his emphasis on leaving the final 50% to the ducks. We're not going to do exactly that. I'm not telling you to sell out in the middle of 2018 and entirely look away from resources. But I think the point he's trying to make is that the real gain, the real money is made in the first half of the cycle, the first 50, 60% of the cycle. And we started right at the beginning of 2016. And if you prescribe to these assumptions, that would mean that it's realistic that, you're going to make a lot of money through mid-2018. Once you head into 2019, in particular 2020, as an investor, I'd become a little more wary. I really would. There's going to be a lot of money made. And the one thing you don't want to do, particularly if you're early in the cycle and looking at the space right now, is to fall off that cliff, that proverbial cliff. So my recommendation would be, if you're looking at the space and you have conviction in some junior resource names, specific commodities, et cetera, would be to get aggressive right now, as long as you're not going to be shaken out by a near-term pullback, and stay that way. Mid-2016, a little bit past, I think you can stay that way for 2.5 years with full conviction and make a lot of money. Once that time period passed, it's going to be tempting to continue to stay in the sector and be particularly exposed. I think that's the time to start taking money off the table. So we do have a really exciting 16 to 18 month period here. We're sure some gains have been made, but I think we're going to see that continue.
Matt, let's talk about diversification, because in a cyclical business, of which mining is probably the most cyclical business in the world, diversification's key. A lot of people talk about the greats of the business. You mentioned Frank Juster, you've got Rule, Sprott, Friedland, we can go down the list, and a lot of them are remembered for their largest successes, that mine that they found that became a buyout by a major for billions of dollars. But very few of these guys had all of their capital or cards locked up or focused on just one company. It's just what happened to turn out the best. And this is a very unpredictable business. Everything does seem to go up at the same time. There are the huge winners in there, but it's very hard to pick which one. I know that your fund and the way that you run it, you're trying to pick quality. You're really focused on management, but you do realize the necessity to pick more than one horse for the race. Talk to me about just the strategy that you hold on to diversify across several different companies.
Sure, and this is not an exact science as cycle time it is, and we just discussed. As far as diversification, I mean, it's important. My main emphasis would actually be on concentrated positions, because generally when people hear diversification in the space where there's 1,800 juniors at least just in North America, and then you can go elsewhere in the world, and the universe gets pretty big with these smaller resource companies. It's very easy to fool yourself into taking a massive amount of companies into your portfolio, and that's tough, because if you're a bottom-up investor and you prescribe to following the company's milestones, making sure they're executing on their goals, and then making your investment decisions off of that, you need to have limited bandwidth as an investor. What works for me is between 10 to 25 holdings. I know that's a pretty broad range. I'm not saying that somebody should concentrate into their 4 favorite holdings, because of course there's risk. There's geopolitical risk. There's risk with management. There's commodity-specific risk. There's a whole lot that can go wrong in this business. But in my opinion, as long as you have at least 10 holdings, I know that seems on the lower end. If you're truly convinced and you've done your homework on each and every one of those, and most importantly, you've vetted management, because that is the most important asset for any of these early-stage companies. The earlier you get in the curve, the earlier the stage the companies are, the more essential quality management is. So as long as you've done your homework, I would feel comfortable owning as little as 10 of these names. For myself personally, I know the max that I can handle is in that 20 to 25 range. So I try to keep it below that. And, whether that means passing on an exciting investment just because I don't have enough time to fully review, or I view a couple companies that are that much better, then so be it. If that means selling a successful holding that's done well for us and management's executed on what they've said, but I view another opportunity that's that much better, that much more exciting, then so be it. So to me, it's very important to stay disciplined and constrain the amount of holdings so that you can actively monitor these companies and not get suckered into getting as many positions as possible just because we're in a bull cycle here.
Yeah, very true point. I think there's a couple different schools of thinking on how to invest. Say, for example, the spot we are in the cycle right now, there's companies, of course, that are up 200%, and there's other ones that are up 600 or 700% in the junior space. The ones that are up 600 or 700%, for the most part, are led by the stronger management teams. They know how to promote a stock. They know how to take a story and craft it for the market. And for the most part, they have better projects than the smaller companies, so that reflects why they're up so much. One school of thinking is that the strongest companies coming out of the gates are the ones that are going to lead through the bull market. Another idea is to look for the companies that haven't moved yet. And then, of course, a third one is, and a great one, if you have a great management team and great asset to focus, and it hasn't moved yet very much, then that would be a good investment. But Matt, I'm here to find out what exactly you're looking at right now. Do you prefer to go for a strong company, something that's already moved, or are you looking to kind of trickle your money down?
Well, you basically brought up three different options there, and I would say roughly the first or third are the way that I would go about it. If you're choosing between buying a great management team that's already run up, particularly at this point in the cycle, as long as you're willing not to get shaken out over the next 2 to 3 months, if we happen to see a correction in precious metals per se, you can go after those golden predators of the world, those Almodexes of the world, teams with exquisite management teams that are really, really good at what they're doing, that are up 600, 700% on the year. And I don't think that's a terrible strategy, and I think it's much smarter than purely looking at a company with gold in its name and buying it because it's only up 100% relative to these other names that have outperformed a lot. There's a reason quality investors are flocking into this name, and again, given where we are at the cycle, it's not a terrible idea to chase the best management teams, even if you're paying higher prices than you did just 6-7 months ago. I would not prescribe to the second category at all. Just because something is underperformed and the rest of its peers have moved, there could be reasons for that. And if you aren't convinced that the actual story and the management team looking at peer price performance is really a red herring. Obviously, you want to find the best of both worlds. And there aren't too many companies out there that have exceptional management teams that have underperformed. That said, there are some out there, and one I'd like to point out, this is not an investment recommendation by any means. I don't know the investment profiles of your listeners, et cetera, but a company named Missouri Minerals, working on silver exploration up in northern Mexico. That's a company that management has made money for shareholders in the past with different entities. It's in a very, very hot space where most of the companies focused on silver in Mexico are up 200, 300%, just for literally having silver in their name and doing a little bit of marketing to the precious metal folks. These guys, probably a marketing mistake on their part, but it can be remedied pretty easily, are listed on the ASX. It's my opinion that they're being completely overlooked. And this is one of the rare cases where you have a really quality team, you have really quality shareholders, the who's who of the institutional world, and you can get into a company that's poised to do very well over the next few years at still a pretty cheap price. So I would look for those exceptional opportunities. At the same time, when choosing between a company that's underperformed and one that has exceptional management, at this point in the cycle, definitely go for the exceptional management.
Matt, let's talk about commodity specifics. You had on when you came on the show 6 or 7 months ago, you had talked about some peculiar commodities like sandalwood, uranium, less so peculiar for my listeners, rare earths. Let's just go through maybe a few of those and tell us what you think. At this point in the cycle, everybody's focused on gold, and gold's already started to move. Gold is more of maybe a sure thing for people interested in Fed policy, potential inflation, deflation, but I don't think that the industrial commodities and the energy commodities like uranium should be overlooked by any means.
I'd agree with that. I mean, the first point I want to stress, and this is just for the partnership specifically, is that we're bottom-up investors. We're not commodity speculators. I wouldn't go as far to say we're completely commodity agnostic. I have some commodities I like due to supply-demand imbalances and others that I don't as much. But the primary commodity the company is pursuing is not the main thing I look when evaluating an investment. I could go through the list of other things, but let's just start with management. And that's kind of the main thing I'll look at. As far as certain commodities right now that do jump out to me after that caveat, I have to return to uranium just because, whether or not your listeners enjoy it, which I think there's a lot of bulls listening to this program, uranium's had a miserable 6 or 7 months to start this year. It's been by far the worst performing commodity from what I've seen. And a lot of investors in that space are fleeing because they're seeing the gains that are being made in precious metals and starting to trickle down to other hard assets. And uranium's entirely unloved right now. I still believe it's the ultimate contrarian investment. I still believe that if you're planning to stick through the cycle and you're not doing a 6 or 12-month precious metal trade, that it's a fantastic place to look. And you can play it in all different ways. There's the pounds in the ground story. There's a couple U.S. Development companies with a massive amount of uranium in the ground, not economic at current prices, but if you look at the supply-demand dynamics and understand that the industry as a whole is producing uranium at a higher cost than the actual spot price, something's got to give over these next few years, and the price will move. And for these kind of optionality plays, which again are the pound in the ground stories that aren't economic at current prices, you can see exceptional gains. At the same time, there's been a lot of money made up north in the development and kind of discovery arena. So these are stories like fission, stories like NextGen, companies that have discovered massive uranium mineralization in the basin and have added value through actual discovery plays. So I think either way, those are two areas you can look. And when the price of uranium starts to move, it's going to buoy all boats. The optionality plays will move the most, but you can create value in the mean term by going for those discovery plays. Second commodity I'll touch on right now, not too contrarian, I will admit that, but we're still big silver bulls at this point in time. Precious metals have moved a lot, and I will admit that. And we also seem to be in the midst of what could be a pullback here. So we saw silver drop below $19 today. I wouldn't be surprised to see, 10 or 15% correction in the price. And for the actual, silver developers, silver explorers, you could see even more dramatic correction in their share price. That said, I think silver is a really, really good place to be, particularly over the next 12 to 18 months. And the reason for that, there's a key difference between silver and gold. Well, I'd say actually two key differences. The first is, and it depends what side of the spectrum you fall on. I'm not a particular gold bug. I enjoy to invest in materials that are actually used, providing value to society beyond just security and a sense of security. And the fact that 50 to 60% of silver is going into very high-tech industrial applications, incredible growth from solar. It's a very, very conductive metal, and it's really important to the high-tech world that we're continuing to advance into. So I really like that aspect about it. But more importantly is the fact that 80% or roughly 80% of silver supply actually comes as a byproduct from base metal mines. And the reason this is important is, when you compare this to gold, which is primarily produced in primary gold mines, the vast majority of gold actually comes from primary gold mines, you'll see a quicker response to higher prices as far as supply goes. You see a quicker supply response with the gold stocks. As far as silver, we've seen underperformance in the industrial metals that are really the primary metals being mined. Silver is a byproduct. And so we're not going to see immediate silver production come online due to this higher price. So there's going to be a lag. That's a big difference between silver and gold. And I think that's why you often see silver outperform in bull markets and bear markets for that reason. A third one I'll touch on, another contrarian name. I do like rare earths, believe it or not. There's a lot of investors I respect and follow in a lot of other instances that roll their eyes at this particular area in the market. And that's reasonable, but that's also why I consider it, a potentially attractive contrarian investment. The one point I'd like to make here is that new rare earth production from outside of China will not come from your typical primary mines, where rare earths are the main metals and the main materials being produced. Instead, I think if you want to make money in this space, you got to look to two other areas. And one of them is treating other people's waste or tailings. I think companies like Medallion Resources is one name that are looking to monetize the tailings or waste of other companies that actually are very high in rare earths. That's an interesting way to play it. Low capex, lean, you can get to production quickly, and you're pretty insulated from the massive cycles that you'll see with rare earths when China decides to turn on supply or turn it off and really affect the price. And the other option is to look at rare earth production as a byproduct. So wherever it's coming from, whether it's other industrial minerals, et cetera, you want to look for rare earth that's not a primary source of revenue for that given mining operation.
Matt, all excellent points that you make. I have a couple comments, maybe just kind of open up a line of discussion here. Your thesis on byproduct investing is something that Rick Rule has talked about on Palisade Radio before, and he probably does it quite more eloquently than I will. But taking a obscure mineral like cobalt, for example, which is starting to get a lot of love from the market, but is still kind of quiet. It's a commodity that goes from $10 to $50 per pound and back to $10, and that's because it is typically a byproduct of copper and nickel mines in Africa. The primary source does not come from primary cobalt mines, and so when you get a lag in supply, these things really take off. And if you're able to position yourself in a company that has a lot of exposure to that particular metal, you were using silver as an example, it's gonna really outperform any of the other sectors when it starts to move. On uranium, I think that's very interesting because you're right, uranium's been in just a horrible 6 months here. The spot price of uranium's continued to drop, and yet with the cycle starting to move up for commodities as a whole, this hasn't been for all uranium companies, of course, but you've seen maybe 25% of these uranium companies are well off their bottom. Some of them are up at 200, 300, 400%, and I think that's the speculative capital just starting to expect what's going to come for uranium has already come for gold and some of the other resources. So are these some things that you take into consideration when you're investing?
Well, sure. Touching on uranium right off the bat, I would say the names that are doing really well right now are the select high-grade discovery names. So these are companies discovering deposits that are so high in grade, it might take quite a while to get them to production, which is something that's really important to take into note. I don't think investors that are piling into the basin right now realize that some of the development plays they're investing in won't be coming online until 2021, 2022, 2023 due to permitting, infrastructure reasons, et cetera. But that said, those companies have done really well. The companies that have lagged are the pound in the ground optionality stories as far as uranium, and there's going to be the biggest upside there. You've already seen that with gold so far, and particularly silver. The companies with the very large bulk deposits, low grade, have seen the biggest moves. In some cases, 600, 700, 1,000% in some of these, bigger silver, copper, gold plays. That ounces looked very uneconomic in Q4 2015, but now as the general uptick in metal prices continues, investors are getting excited and starting to apply a higher metal prices into their models, and they can see that a project that seemed completely worthless just a year ago, giving you a 30 to 40% rise in prices, could be worth hundreds of millions of dollars. So that's where you're going to get the biggest torque. And honestly, I think it's just it's an investment decision for the individual investor. How confident are you in the rise of the actual commodity price? How do you want to play it? You have to know exactly what you're doing, though. And again, I continue to harken back to this, but it is really important. Look for management always. You need good people in charge that are taking care of you, that have skin in the game and are trying to take care of themselves. That's just as important. And whether you're investing in a discovery play with fantastic management or an optionality play with very low G&A, they're willing to consolidate ounces, wait out this bear cycle, particularly in uranium, without doing any stupid expenditures, deals, etc. Those are the companies you want to be involved with.
All right, very good. And Matt, let's end with one more topic that I talk quite a bit about on my show. This is something you sent over in the show notes. When investing in the resource sector and you're financing a company directly, you're typically going to get a warrant attached to the shares that you're buying. And as Rick Rule says, that's the risk that you're taking. That's the reward, the potential upside reward that you get for taking that risk of financing something that is so speculative, is that upside afforded by the warrant. There's a couple different schools of thought. If one could pick the 100 baggers that are going to come out of this cycle and do it effectively, buying in the open market would be a great way to make 100 times your money. That's simply not how it happens. So it's good to at least mix some of the warrant strategy in there. Talk to our listeners a bit about how you see warrants and the way that you use warrants in your strategy of investing.
Well, I'd agree with Rick's assessment first off. If you're giving money directly to the company, you have capital, potentially strategic capital that you can provide to help them advance their projects. You do deserve a sweetener beyond your average retail investor. That said, it doesn't necessarily need to be through the form of warrants. It could also be the form of a big discount. So common shares could be trading far higher than where the placement's actually taking place. That's another way to get a sweetener. But focusing specifically on warrants, I'm not going to say that there's a right way to do it, and really it just depends on the particular investor and their strategy. Just as I was discussing whether to go optionality or discovery, really depends on the particular play and the particular comfort level of that investor. I have my own strategy, and we generally do not clip warrants by any means, as long as the companies that we're investing in continue to deliver on the expected milestones that I've drawn out before the investment takes place. But, instead of talking about our preferences, I'd rather just outline the pros and cons first of whether to pursue a warrant clipping strategy. And again, that's the concept of anytime you take part in a placement, you're going to receive common shares and then the warrant sweeteners. You have to hold those common shares for generally 4 months, a 4-month hold period. And then immediately after that, you can choose to either dispose of those common shares and put the money to work or keep it in that company. And again, there's no hard and fast rule, but there are some pros and cons. As far as if you do pursue warrant clipping, you get fantastic velocity on your money. And the concept there is that you can basically jump from company to company every 4 months, accumulating upside, and these warrants provide good upside, especially in the junior resource space where if things go right, forget about the 10 baggers, but even 4 or 5 baggers over the course of a 2 to 3 year cycle, your warrants will be well in the money, and you're going to make, you're going to make out very well on your investment there. That said, there are some cons to the clipping of warrants. One thing is that over any given cycle, it's generally not going to hurt you. But over the course of a career, if you're trying to really be involved in the higher quality deals and the higher quality names, management's going to look at your track record and realize, is this an investor that actually wants to stick with the story beyond the 4-month hold, or is this an investor that's going to opportunistically cash out? And that's just something that has to be taken into account if you're doing the warrant clipping strategy. Additionally, a risk that I see is that it could cloud your judgment on selecting high quality assets. And when you're always thinking through the lens of, well, I can always sell in 4 months if things don't work out, you're going to not be as judgmental. You're not going to be as discriminating in your choices, and you're going to, look at lower tier projects, management teams that don't necessarily have the same track record of other investments. And you can also find yourself holding a much bigger portfolio with more names, too diversified in my mind, than you otherwise would want to. And then the final point here, and this is debatable, but really you're not going to be able to get those 10, 20, 100 baggers without holding the common shares. You could argue that you could hold the warrants over the same period and make very good money. And that is a valid point. But at the same time, these expert investors that are talking about their successes over the past cycles where they've gotten 50 or even 100 times their money, these were committed shareholders, and management knew that they were involved. Management knew that they had their back. They provided strategic value throughout the process. They provided capital on multiple different raises. And so in my mind, you're forfeiting that ability to go for these kind of big wins that we always dream of if you pursue the strategy very, very religiously and always sell after 4 months. So kind of wrapping up on that point, for us specifically, we try to keep, if we're going into an investment and going into a placement, as long as the company continues to deliver on the milestones that I set out before the investment, that management and I agreed were reasonable, then we're going to stick with that name. And, as long as the company's delivering and their share price doesn't rise far beyond the fair value or the speculative value that I'm using for that company, then we'll continue to stick with them. So there are really a couple different approaches that you can follow. It does depend on the individual investor, but I think going into placements, you should understand exactly what your strategy will be and whether you're going in to clip the warrants or whether you're looking at this as a general investment and plan to hold the company beyond that 4-month hold period as long as they deliver on their stated goals.
Wise words, Matt. We were supposed to only record for 15 minutes. We're already at half an hour, and we could keep going, but I'm going to end the interview here. As I always say to my listeners, feel free to reach out to me if you ever have any questions. Colin at palisadeglobal.com. Matt, I'd like you to share your information. I believe, without speaking for you, your fund is potentially open for the right kind of investor if they come along. And, if you're just too swamped with your time to do the kind of due diligence that Matt or myself does in this sort of thing, Matt offers a way for you to capitalize on this bull market that we're in, and his fund has performed excellently over the last 6 months, and I would expect it to continue to do so. Matt, please provide some details on how to get in touch.
Well, thanks, Colin. Yeah, for any interested investors, and again, this is not specifically for potential LPs by any means. I love talking this stuff. I have an extreme passion, particularly for the companies we hold, but also companies that I'm constantly evaluating, because you can always make your portfolio better. You can always optimize that much more. So whether you have questions about a particular security, anything I said during the interview, or just the fund in general, feel free to reach out to Matt at mjgcapital.com. That's Matt at mjgcapital.com. And I'd love to go through, as much as we need to. This is a really exciting time in the space, and I do firmly believe that this next year and a half to two is a time to really dig in and make your money.
Matt, thank you so much for coming back on the program.
Thanks, Colin. I look forward to the next talk. Cheers.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?